This week we're going to do a little bit different. The markets were quite chaotic last week, and they continue to be so today. There's a lot going on. We're going to focus on specifically some custodial issues at Schwab and Fidelity we want to update you on. Then we'll talk about what actually happened in the market with some of these institutions that have failed or are being helped out by the Fed and FDIC, and what impact that's going to have. Needless to say, it was a rough week for markets. Equities were down big, fixed income rallied, largely on the backs of what had happened within these financial institutions. But let's first start off with an update on Schwab and Fidelity, because that's where our client assets are primarily custodied. And I think it's important for clients to understand what is actually happening at these institutions and what it means to you individually for your assets at Schwab and or Fidelity.
Yeah, and the first thing is that Schwab and Fidelity, they are in compliance with the SEC's customer protection rule. And what that basically means is all mutual funds, ETFs, all funds positions held in any custodial account are basically never touch Schwab's balance sheet or Fidelity's balance sheet, and could never be touched by creditors in the event of a credit event or insolvency. So when you go out and look at your Schwab account or your Fidelity account and you see all those mutual funds, those have always been 100% safe, separate from any type of credit event.
Because those assets are registered to you as an individual, not to Schwab as an entity. Correct?
Exactly. So that's sort of the low-hanging fruit here. That takes care of about 99% of assets, right, at these two custodians. And then the only exposure to these entities' balance sheets comes through sort of transactional cash that can be swept onto the bank balance sheet. You'll see like a Schwab Bank sweep or a Fidelity sweep type product. And those are subject to traditional FDIC deposit limits. Insurance limits. So anything under $250,000 is FDIC insured. And that takes about care of, basically everything else. Right? I mean,
so when you say FDIC insured, you mean that if something was to happen with that bank, they would get their full $250,000 back.
Yes, exactly. It would be an insured deposit, just like at any other bank.
Right.
And that pretty much takes care of all of it. Now, we say all this. The other part of the situation is we have no concerns about Fidelity or Schwab being subject to a credit event or anything like what happened last week with Silicon Valley and Signature and Silvergate. But it's important to say those things up front, because even if those things were to happen, all client assets would be fine.
Right. And I think that another level to sort of put them in perspective is we scan every week for any deposits and accounts that are over $250,000 to make sure we do get that money invested in a registered mutual fund or ETF, whether it be a very short-term bond fund, a money market, but we routinely sweep to get that money invested. Yeah. So it's very important.
And that's probably an important distinction as well for all those listening who may go out to their account and say, oh, well, I have over $250,000 in a money market mutual fund, a Schwab variable price mutual fund, whatever the case may be. That is a mutual fund product. It is not on Schwab's balance sheet. So that, once again, would be legally separated, could not be touched by any creditors.
So that's important, because it might show to you on your statement or when you log in through your portal, it might show as cash, but it actually isn't a registered product. And we did our routine sweep this morning, and anybody who was over 250, there were a handful of people, because of trading activity, that money was all swept in under as normal. So I think that's an important point to reference. If you have questions on that, Schwab has a lot of resources, Fidelity has a lot of resources on their website, or feel free to give Mike or I a call, or anyone on the private wealth team to just check in and understand better how this works.
Yep.
So let's talk about what actually happened over the last week leading into this, and then over the weekend with the Fed's response, the FDIC's response.
Yes, we have three failed banks. So you have Silvergate Capital, Silicon Valley Bank, and Signature Bank. And there are a few commonalities between these three banks as to why they experienced a run on deposits. The first of which was they all experienced rapid deposit growth, really post-pandemic. I mean, you can see these are their share prices. You can see how much they went up. I mean, you look at something like Silvergate Capital, that was pretty much a nothing stock until late 2020, early 2021, and then it got as high as $222 a share. Yeah. The other commonality between these three banks is a lack of a diversified deposit base. So if you think about Silvergate, they were basically the banker to crypto exchanges. And when crypto exchanges started to go belly up, folks that had their money on these exchanges started pulling their deposits, and you basically had a run on Silvergate. Mm-hmm. Silvergate was relatively small, so that one was basically allowed to fail. That was the first one. And then contagion sort of started to spread. You move on to Silicon Valley Bank. Their depositors were primarily tech startups and IPOs. And we know those companies had been burning cash for quite some time. So if you're a tech startup, you get funding from a venture capital firm, you deposit it where else but Silicon Valley Bank, because they sort of have the tech startup private equity portfolio company banking package. Yes. Where, if you leave all your money with us, we'll give you, this whole suite of products and services. Nice toaster. Right, for sure. And so as all those companies were burning cash, they were pulling money out, pulling their deposits. So they sort of had a run there. And then Signature also had some involvement in crypto exchanges. They were the last one this weekend. They were basically put into receivership almost proactively. Mm-hmm. They had sufficient assets to cover all their deposits, but this was definitely a proactive move by the Fed and the FDIC and the Treasury to say, if there is another shoe to drop at Signature, let's just get ahead of it. Right. Yeah.
So these were all sort of unique situations in themselves. But talk about just generally, there's been panic. Schwab stock price has gone down considerably. A lot of these regional banks have been suffering. What is the primary reason people are concerned about these deposits?
Yeah. Well, last week, the concerns were, I have an uninsured deposit, meaning a deposit at one of these banks that's larger than $250,000, and deposits are leaving the bank. There is a run on the bank. Mm-hmm. And so I need to get my money out before there's no money left. Because in order to satisfy these deposit requests, these withdrawals, what Silicon Valley and Silvergate, et cetera, what they were doing was they were going to their asset portfolio, which had a lot of investments in safe things like treasuries, mortgage-backed securities that are safe. And if they could hold them to maturity, they would get 100 cents on the dollar for. But they were trading at an unrealized loss because we just went through the second fastest rate hike cycle in history. And a lot of these treasuries were bought back in 2000 at a yield of something close to zero. Right. So that was the concern last week. I got to get out first before there's no money left, right? And that contagion started to spread and spread and spread. But then with the actions taken by the Fed this weekend, those concerns are all but solved. Now, the FDIC has come out and said that they have created a backstop that is enough to satisfy all deposits at all U.S. banks, whether they're under the $250,000 FDIC insurance limit or over.
Yeah. So the FDIC can handle it, not the taxpayer.
Exactly.
So explain that.
Yeah. So the FDIC takes in fees from all the member banks because when stuff happens, somebody has to pay for it. Mm-hmm. And so basically the banks would pay for any losses incurred by the FDIC by coming in and backstopping deposits effectively through their fees. And if there are any other losses, say the FDIC doesn't have enough money, they'll just assess higher fees on member banks later. So the taxpayer will not have to pay for it. The banks would have to pay for it or have already paid for it.
And
right.
Would that put additional stress on the banks?
It shouldn't. I mean, especially the large banks. I mean, it's sort of a rounding error, and they've been paying into it and have budgeted for it, et cetera. So it shouldn't be that significant. But basically, over the weekend, if you were worried about your deposits, you shouldn't be worried about that anymore.
Right.
And so then the other concern is the asset side, right? You're the bank, and you say, well, what if I just have to sell these assets at a loss, these treasuries and mortgage-backed securities? Well, the Fed basically took care of that. They came out and bank term lending facility, so a new special purpose vehicle lending facility, and said, we will give you funding, banks, we will give you loans for very cheap, based on the par value of all the assets of all your treasuries and mortgage-backed securities. So it's as if the market value losses don't exist for at least a year. So this was very swift, proactive, significant action. And the fears of last week are not the fears of this week.
So also not a bailout.
Right. And not a bailout because this is the last piece that the Fed and the FDIC didn't solve, is if you held stock in Silicon Valley or Signature or any of these other regional banks, or you were an unsecured debt holder, you lost all your money. And so that's probably what we're experiencing this week, is not fear of a run on a bank and having to sell securities at a loss. It's a fear of, I own stock in these banks. If they go to zero, I lose all my money. So now I just, due to risk management's sake, I'm going to sell my shares of any regional bank that looks like it's anywhere near this event.
Right, which we've seen, especially today.
Yeah, and that's how you get something like Schwab down 20%, even though you look at their business model, their assets, their customer base, and everything the Fed has done, and you say, this is nothing like these banks that happened last week, and significantly larger.
Yeah.
So, yeah.
So any compare and contrast the systemic risk of 2008 in the banking and what happened in the banking industry, and today what's happening?
One of the fundamental differences is in 2008, the problem was the assets that the banks had, mortgage-backed securities, et cetera, effectively were worthless. And so they had to dump them. There was a fire sale of the assets, and it turns out everybody owned those assets. So everybody's assets on their balance sheets had to get marked down, right? And that was the systemic contagion of, mortgage-backed securities going to close to zero overnight. What's fundamentally different this time around is the asset we're talking about here are plain vanilla U.S. Treasury bonds. And those are being sold by these banks to meet these requests, these deposits, withdrawals. But the prices of U.S. Treasuries have gone up a lot over the past 3 days. I mean, today, the 2-year Treasury note yield is down 0.5%.
Yeah.
So if you have a bunch of treasuries, you're a bank, you have a bunch of treasuries on your balance sheet, you're saying, this actually isn't too bad. The market value of these securities has gone up a ton in the past 3 days.
Yeah. Can we put that graph up and talk through that?
Yeah, the Treasury rally. I mean, here, the dark blue line is the 2-year Treasury note yield. The 10-year is the purple. And just going to show back in the 2000s, that's when Silicon Valley was buying these things, right? And then here we are today. So that's where Silicon Valley bought. Somewhere up here is where they had to sell to meet deposits. And because of that, and that systemic risk and that contagion, you just get this blue line and purple line just dropping. I mean, the 10-year note yield has gone down 1% over the past 3 days.
Yeah.
The 2-year note yield is down 50 basis points today. That's the sharpest drop over any 3-day period since Black Monday 1987. So once again, when bond yields go down, prices go up. So, and now we're at the point, this is where we just complicate the situation even more, right? The Fed's meeting next week. And you're at the point where the Fed funds rate is above every single maturity treasury across the yield curve. Complete inversion now. You see the purple line and the blue line below that red dashed line. So yeah.
And so the expectation being priced into the market for next week has changed dramatically.
Yeah. It's at one point last week, it was definitely going to have to raise rates by 0.5%. And then it came back down to 25 basis point rate hike. And now it's a coin flip if they're going to hike 0.25% or not. We'll ultimately see. What further complicates things is tomorrow, CPI day.
Yeah.
So, and the Fed goes into the quiet period. So we get CPI. We got the non-farm payrolls last Friday. I mean, the economic data suggests the Fed should still be hiking. The inflation data is probably going to show that month over month, we've made almost no progress on reducing inflation. So how do you, the Fed, juggle these two things? I have 3 banks fail in a week
Right.
because of my rate hikes.
Right.
But I also know price stability is part of my mandate, and I have not showed progress on bringing down inflation.
Yeah, and so we could debate this all afternoon, but I think the reality is this shouldn't change the Fed's thinking in terms of we've got to defeat inflation, and now is the time to do that. But it could impact in the very short term. So it is relatively interesting to see how they'll react to this. But I would not be surprised if they continue on their path, because in the longer battle, beating inflation is what is needed here.
That's exactly right.
They've really, it's amazing how quickly they've contained this issue. So if another bank has trouble, there's a way out. So, and it was done quickly. So they put the Band-Aid on that. The bigger wound is the inflation wound.
That's right. That's right.
All right. What else do we have for this?
Well, we can talk about what the market thinks about all this.
Yeah. Okay.
In terms of what the Fed's going to do. Because to your point, I think we think the Fed would like to think about this as 2 completely separate things. We have the failure of 3 banks. We took care of that. We backstopped all deposits. Anybody who had money there is fine. If you had stock, too bad. If you were an executive at one of those banks, too bad. Then we have our fight against inflation. Totally different monetary policy tool. This is us raising interest rates. And so, we show here the market implied path of the Fed funds rate, what the market thinks is going to happen. Well, last week, the market was expecting that the Fed funds rate would progress throughout the year, something like this red path, right? Almost 5.5% peak rate in October because of the strong economic data, labor market data, so on and so forth. And then you get 3 banks failing and you go down to this green line. And why do you have this reaction? Well, because in any other rate hiking cycle in recent memory, if 3 banks fail, the Fed is cutting rates to 0 immediately, right? So there's a knee-jerk reaction here, the Fed will hike until something breaks. Well, a few things broke. So that's the market reaction, is to say, all right, well, they're effectively done. Maybe they get 1/4 percentage point rate hike in, and then they're done. And, we think that unless these systemic, or if the banking thing becomes systemic and creates a recession, then that green line might be right. But the actions they've taken would suggest that's probably not going to happen.
Right. Yeah, because they've solved it.
Right.
In the short term.
So, the red line seemed too high, and now the green line seems too low. So, not an enviable position to be in as Fed chair. We can empathize, but it will be very interesting to watch.
I think there'll be a lot of political pressure probably to not hike.
Right.
But Jay Powell's proven so far that he's going to do what he wants to do in order to defeat inflation. So I would not expect, at least, it'd probably be somewhere in between, like we said last week. But I would not be surprised if they continued on the path aggressively. All right, that's the quick update for this week. As always, give us a call. Let us know if you have any questions, and we'll be back next week with an update and look at performance.